Michael Burry is as infamous as an investor can get. He really doesn't need an introduction, but when I choose not to give him one, I'm inundated with people claiming he's a one-hit wonder, so let me make things clear. He is, without a doubt, one of the most successful investors alive. He accurately timed and profited off of the two largest asset bubbles in the 20th and 21st centuries at times when almost all other investors found themselves practically bankrupt. Burry found himself fantastically rich. From 2000 to 2009, when he ran his firm Siren Capital, Burry returned over 500% net of fees to his investors, while the S&P 500 returned just 3%. The reality is, Burry has beaten the market for as long as I've been alive, and he did so mostly under the radar. It has only been with the explosion of the film The Big Short which has given him this public platform, and it is clear as day that it isn't something that he actually wanted. It's no surprise then that he frequently goes AWOL and disappears off of the face of the earth, focusing on his own investments and ignoring the noise from everyone else, but every now and then he returns, he reactivates his Twitter account and blesses us all with some wisdom, and that is what just happened. A few days ago, Burry practically came back from the dead, and he had only one thing to say, that Web3, cryptocurrency and NFTs are the biggest bubble on earth, and worse than that, the vast majority of it all is a scam as well. He's telling us in no uncertain terms that the Web3 crypto bubble has already crashed, we just don't know it yet. Now really quickly before we get into that, a quick thank you to this video's sponsor Composer who made this video possible, but more on that later. So what exactly did Burry tell us? Well, he literally only did one thing. He showed us one thing, and it was a Twitter thread from John Reed Stark, who has worked for the SEC for 18 years, spending 11 years at the top as the Chief of Internet Enforcement. He's taught cyber law at universities in the US for decades as well, and he spent 5 years fighting cybercrime on top of that. It's probably safe to say then that if you're looking for context into what the SEC thinks about crypto and Web3, about what the governing authorities think, then there is nowhere better to look than inside the head of John Mind himself. To show us this thread, to alert us as to what John is saying, is literally the sole reason for Burry's return to the internet, and so it's clear to me that these are the views of Burry himself. Today, I'm going to explain exactly what is said in this thread, why Burry believes this, and finally, put everything into context so you can understand what he's saying as well. So where does this all start? Well, with John explaining some of the root problems with certain parts of Web3, starting with NFTs. A fractionalized link to a JPEG of a bored ape with funny glasses and a colourful hat is not a sound investment, sensible means of commerce, and prudent pathway to live out the financial dream. A piece of computer code devised by one person in 2008 that solves no problem and does nothing except to the extent that some other fool can be induced to pay more money for it will not usher in a global monetary policy to cure everyone's financial woes. So to kick us off, we hear about how NFTs are not sound investments, how they're not going to change your life and make you rich beyond your wildest dreams. We also hear that Bitcoin, or any of the myriad of other cryptocurrencies out there, aren't going to fix our financial system either, and both of these points are true to an extent. Buying a hyperlink of a monkey for $300,000 is an awful idea, and if you manage to make money doing that, it's only because someone else lost that much money doing the same thing. There is also the point that even if the world did switch over to Bitcoin or some other crypto, the world's problems with too much debt or derivatives in the financial system wouldn't automatically be solved, but there is one glaring problem that would be solved, and that is the debasement of our currency. Bitcoin may not be perfect, but it can't be printed. And in a world where almost every government turned on the money printer simultaneously and decided to essentially steal from their citizens to fund their programs, a code-driven currency where that isn't possible is actually a very good thing, something that is entirely ignored in this thread. Now, if you're like me, you're constantly thinking about how best to get an edge on the markets and really make your investments work for you, then you need to hear about this video's sponsor, Composer. They provide a new automated trading platform that allows you to build your own investing strategies called symphonies that automatically work around the clock to your set specifications. Say you want to buy the dips of NASDAQ stocks without having to physically make those trades yourself. Well, there is a symphony that will take care of that for you. Or say you want to invest just like Warren Buffett does, buying and holding solid, underpriced companies that produce reliable cash flows. Well, there's a symphony for that as well. Personally, I've used the site to build a Stoic Finance inflation hedge symphony for myself and everyone else that is designed to protect against inflation and hedge against a recession, as I see the Fed's interest rate hikes and quantitative tightening causing poor market performance for the next year at the very least. You can copy other people's strategies like mine, you can edit them to fit your needs, or build one entirely on your own using logic gates so you never have to write a single line of code. The possibilities are quite literally endless, and it's really easy to use. You can even backtest your strategies to see how they would have performed in the past. So if that sounds interesting, if the idea of creating your own mini hedge fund strategy or investing just like I do sounds appealing, then make sure to check out the link down below in the description. I personally will be investing my own cash into the Stoic Finance Symphony, as I've literally designed it to perform well in a high inflationary environment. Link, as always, is down below in the description and the pinned comment. DeFi is inefficient, wasteful, and uneconomical. It facilitates massive energy consumption, it increases network congestion and bugs, it's environmentally destructive, and as so many experts have stated, it's cumbersome, unwieldy, bulky, burdensome, clumsy, and the list goes on. DeFi is plagued by high network transaction fees, failed transactions, net capital issues, blockchain vulnerabilities, privacy and cybersecurity weaknesses, software forks, and blockchain patching code challenges. DeFi's risky leverage and equity mismatches, built-in interconnectedness, lack of shock-absorbing capacity, and poorly understood infrastructures all undermine financial stability, creating systemic and bank-run risk while exacerbating issues of pro-cyclicality and destabilization. So next, we see John change targets, and he starts to attack decentralized finance, something which I am a steadfast supporter of, and here again, many of John's points do hold true. Much of DeFi is bulky and awkward and hard to understand, and much of it is powered by proof-of-work consensus methods, which eats up power and contributes to climate change. But this is all new technology, and new technology always comes with teething problems. Phone calls used to be inefficient, needing literally millions of miles of cables to be strung up all over the place and millions of people to manually operate the switchboards. But the industry evolved, just as DeFi will evolve as well. The most egregious mistake made by John there, though, is to take aim at DeFi when talking about excessive leverage, as if the entire traditional financial system of the world isn't still teetering on a knife edge as we speak, and that's after countless catastrophic collapses that have all been caused by excessive debt. In this case, crypto is by no means the problem here. Web3 lacks formalized accountability structures and fiduciaries, creating a den of thieves, robber barons, and shameless profiteers, preying upon those most susceptible to get-rich-quick schemes who have the most to lose, money they need to live, and are often the most vulnerable. Web3 applications typically present monstrous scalability challenges, rampant exit scams and rug pulls, extraordinary market manipulation and insider trading risks, front-running, transaction reordering, and consensus instability. Web3 adoption benefits mostly criminals seeking to shelter or hide their profits from ransomware attacks, drug dealing, terrorism, sex trafficking, money laundering, and most other crimes. Crypto reduces efficacy of US sanctions, enabling transfers of funds outside financial systems. So then, John went on to attack the myriad of scams, rug pulls, and criminal activities enabled by Web3. But here again, John is missing something. Those formalized accountability structures that John is critiquing Web3 for not having are the same institutions that helped Pablo Escobar launder billions of dollars. Every single criminal empire the world has ever seen really has been funded, run, and operated using traditional finance. And in the 10 or so years since DeFi has existed, there has been no explosion in international crime rings or drug trafficking. Now that being said, John is right about one thing here, and this is the prevalence of rug pulls, exit scams, and just outright thefts and hacks that occur under the Web3 banner, and this is something that needs changing, but outlawing crypto is no way to go about it. Those spreading the myth that crypto transactions are easy to trace remain sorely misguided, to say the least. This is perhaps the most absurd, frustrating, and entirely misleading of all crypto enthusiast retorts. If crypto were so easy to track, then the tens of thousands of ransomware attackers would all get caught. But the reality is that only a minuscule few are ever even identified, let alone apprehended, charged, extradited, and brought to justice. While crypto payments, if not obscured or properly laundered, might in some instances provide a glimpse into the chain of where crypto is going, the chain does not identify who the crypto is going to. The increasing use of advanced obfuscation techniques makes blockchain analysis difficult, often impossible, and resource intensive for US agencies. Criminals now commonly use anonymity-enhanced tools to hide illicit transactions to facilitate criminal activities. Tracing crypto transactions to catch criminals requires immense resources, years of doggedness, and lots of luck, and prosecutorial success rarely ever happens, period, end of story. So there we saw John go on to complain about how easy it is for people to hide using crypto, and again, there is some truth to what he says. If you're smart and you don't make any mistakes, it's almost impossible to be caught from the blockchain, but the reality is, most criminals aren't smart, and the easiest way to see this is to take a look at CoffeeZilla's YouTube channel, who has built a career for himself as a blockchain detective, tracking and outing so many different NFT or crypto scams, I don't even know where to start. Maybe it's a different story when dealing with drug traffickers or people who really do know what they're doing. But from what I can see, every criminal makes mistakes, and those mistakes can be picked up on because of the blockchain, not despite it. The problem here lies with how our justice systems allow these pump and dump scams to occur, and our authorities who lack the creativity needed to catch those thieves, not the systems themselves. Crypto presents few real economy uses and is used mostly for speculation or arbitrage. Crooks who revel in crypto's pseudo-anonymity and perhaps early adopters who have transformed themselves from victims into victimizers seem to be the only real winners in the crypto community. The NFT marketplace seems wholly rigged. Market manipulation of NFTs appears not only rampant and tolerated, but also encouraged. Fraud not only rewarded, but also taught. The cybersecurity risks alone render NFT markets a dire and absurd choice for any sort of investment. Crypto, DeFi, NFTs, and the rest of Web3 generally tout the same tired and faux libertarian notions of decentralization, except with even less protection, even more fraud, and even more unlicensed, unregulated, and suspect money-sucking intermediaries. What problem does Web3 solve, and is Web3 even remotely worth the risk of its intrinsically perilous externalities? Big Crypto wants you to believe Web3 is the future, but the reality is that Web3 is indeed the future, except only for Big Crypto. For the rest of us, not so much. Now this final paragraph here really sums up why I disagree with this thread as a whole, despite agreeing with so much within it. I see decentralization as a good thing, and the reason to pursue Web3, not the underlying problem with it. John clearly wants the power to remain in the hands of the few, but he is one of the few as someone with authority within the SEC. The question I'm left asking is whether those people and institutions deserve to have that power in the first place. We wouldn't be seeing people like Floyd Mayweather or Jake Paul scam people using NFTs and rug pulls if the SEC simply regulated this industry and prosecuted those criminals. On top of that, our governments are not infallible. They have done awful things countless times before, and they will do awful things long into the future as well. And while crypto and DeFi isn't going to stop that from happening, it just might allow us to protect ourselves in at least one way from being at the total and complete mercy of the state. Now, as for Michael Burry, we really don't know exactly how much of this thread he believes with, but it is safe to say that he runs in the same direction. We know for a fact from his statements in the past that he thinks crypto and DeFi are in a bubble, and I think that as well. The simple truth is that right now, the practical uses of everything Web3 are basically negligible and by no means even come close to justifying the ludicrous $2 trillion market cap of that industry. But just because it's a bubble now doesn't mean it will always be a bubble. Amazon in 2000 before the dot-com crash was a bubble, and the housing market in 2006 was a bubble too. Crypto today is a bubble, but those industries in the past didn't cease to exist as they became apparently appropriately priced, and there's no reason to believe that crypto will disappear forever either. It will take time for Web3 to develop. No one is pretending it won't. Yes, it is fraught with scams and rug pulls. Yes, it is expensive and inefficient. Yes, it does use up ridiculously excessive amounts of power, but these are all things that are actively being fixed as we speak, and when new technologies have teething problems, we don't simply throw them away and never consider them again. We work to ensure that they move in the right direction, and eventually we use these new technologies to institute real change. Finally, just before we go, I'd like to thank this video's sponsor Composer for making this video possible. Their platform is really impressive. It allows you to invest like never before, and in the near future, I'll be building my own symphony, putting my own cash into it, and you guys can follow along and see how it goes, so make sure to click that link in the description. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than we get from any savings account these days. Thanks for watching, stay stoic. Until next time.